Oh, wait a second.
You are.
Is this a good amount to be up like
Um,
40%?
yeah,
40% on a zero to date?
that's real good. What are you
Oh yeah,
talking about?
you're chilling. 40%'s good on a zero to date. Yeah.
Oh yeah. I mean,
Hmm.
usually I stay around like 20 to 30. You're up 40. I would get out. Jesus.
Nah.
And let's do that
Why?
buzzer stills. Jesus.
All right, I think I'm back. I think the stream's
I
back up,
just
just so
think it's
everyone
gonna.
knows.
I just
Sorry,
think it's
what,
gonna
Josh?
fall
Profits
more.
on that downturn, Josh. You could go lower, but I just wanted to play the breakout candle up, and then I wanted to play the retest candle back to the high from earlier this morning, and that's exactly what we got.
No, when I had technical issues, I closed all the puts for profits.
That's
Good
good.
shit.
Real good.
I'm not playing that game.
No. Not on a FOMC day.
Not when I'm fucking blind.
Yeah.
Yeah, I'm not trying to trade fucking aggressive contracts off my phone. It's still such a pain in my butt, dude.
What's wrong with trading off your phone?
That's
Awful.
terrible. Yeah, it's really bad. I don't like it.
You take it back.
I'm not going to. You can't make me. But no, it's really bad trading off the phone. I would even
Holland,
say
10 minutes.
I would even say iPad. That's really
9
bad trading
minutes.
on an iPad as well.
Nah. That's okay.
All right. So we got the first move up. Second move was a flush back down. Let me look at the 5-minute.
Now we're going back
This
up.
is still the same move.
It defended your lower EMA channel. Really
How's it going,
well
boss?
on the 1 minute.
Good.
All right. Hold up.
He's
They're
going
gonna probably
low.
move back to the upside again.
What
Play
did I
this
say? He's
fucking
putting it back up.
volatility. Going for the 519s. We're gonna do 520s. Let's do 520s. See if we go in the money on these. That'd be insane.
You're doing ODT again?
Yep.
Jesus, this dude.
He's so handsome, isn't he?
Yeah, I like that. Blew through both the EMAs, confirming
Yep.
now on the way
That
up.
was look at this level I had set VP.
Hold up.
To the T. I took profits at the bottom of this red candle.
Hell yeah.
To the T, and then we bounced.
You bought the
Oh.
20 or the 19?
20, bro. I'm going dude, they're way riskier because you're farther out the money, but dude, the volatility's here today. And this is, dude, I mean, this is the news we're waiting on to get out of this chop range. So if your bet is on up, we should see a pretty good move.
Hey. Psst, guess what?
Hey, just so you know, we're live on YouTube.
Broken fuck.
They're up 10%.
What did he say? What just happened? GSP, just so you know, we're live on YouTube.
Psst, hey.
Yeah.
5.5% is still negative interest rates.
How long in 7 minutes?
Dude, I'm watching this so close.
Question is, what the fuck is Powell, like, what is he gonna point at this time? You know what I mean? Like, what's his metric of fucking measurement today? Gonna be unemployment? Is it gonna be CPI? Like, what is he gonna show us?
We'll find out.
He's gonna say the overnight mortgage swap credit default rate market. Fuck you, pal. The mortgage swap facility window market interest lending rate overnight credit wash. You think they're gonna release a new fucking facility?
What?
For these commercial real estate loans.
What do you mean, like a new BTFP program?
Like basically, the Fed's gonna monetize these junk fucking commercial loans.
Nah, I don't know why they would. I don't think they will.
How much time before he speaks again? Or how much time is he gonna be? Like, how much time do we have left before he starts speaking?
5 minutes.
5 minutes. I'm really looking on Trading View.
This motherfucker.
I just want to see a fucking big ass candle. It doesn't matter which way. I just want to see like $2 move in one candle on a 15-minute candle.
Right here, good for you. All right, boss. Have a good night.
Holy shit, it's cold. Oh,
That lady had a drink that looked really yummy. I would need a drink that's yummy. Oh, it's surging. Let's go pick up free money off the street. Don't mind if I do. What are we doing here? What are we doing?
Come on, push through right here, Spy. Push through right fucking here.
I think when Powell comes out, they should play YMCA.
Young man.
It's like Trump. Doesn't Trump do that? Imagine Powell doing like a light jog to the podium to that, and then pointing at people like Trump. Be like, "You, oh yeah, you're here. I see you."
I'm out of these.
I would get a kick out of that.
I'm out. I'm not gonna take these.
Here we go. Here's the push.
Yep.
Calls up 18%,
Oh, I'm glad I got out when I did.
20%. Do I take profits on that push? More.
There you go.
25%. Give me a little bit more.
How come
Give me to the top.
it only counted for my Webull account? It only counted as one day trade, even though I closed the position in 2 separate trades.
I don't know.
Like I originally opened multiple contracts and then I closed them out in 2 separate trades, but it only is showing that it counted for 1 day trade. I would think that would be 2 day trades.
It's round trip of a position, so since it's the same contract, it still counts as one position.
Interesting.
Round trip in the YMCA theme song.
Trying so hard to push it above those wigs. Come on.
You know you can't will it to go higher.
Really, dude, I normally would just take profits here, but give me just a little bit more.
This ES 1 hour is completely different from the SPY 1 hour.
Oh, here we go. Come on, give me that little bit bigger push.
It's like a huge
Give me
disconnect.
40%.
You know what I would like to see? I would like to see
All right,
the Russell breakout.
26%. Take it. Let's go, dude. Let's fucking go. So
Where do you
heavy on them.
see-
I don't need 40, 50%. I was so heavy on those.
Because once my position's gone, it seems to be gone.
JPal's on now. Kind of let the market digest some things.
Okay, never mind.
Reevaluate. I don't want to get stuck in a fucking chop, dude, and the premiums get burnt.
You don't chop.
Look at that. Right back down for now.
Hmm. Hmm. Ooh la la. Oh, it's going down quick.
Yep, Atlanta took fucking profits there. Let's go.
The economy has made considerable progress toward our dual mandate objectives.
Who's playing
Inflation has eased substantially, while the labor market has remained
it? Oh, I'm
strong.
playing it.
And that is very good news.
He just said good news. He just said the words good news. Boys, we're gonna moon.
Okay, wait, chill.
Dude, perfect time to take profits. Let's fucking go, dude. Didn't get greedy. Did not get fucking greedy. Those would be red right now.
Hey, yeah. Can you stop talking?
Sustainably strong labor market that benefits all.
Damn.
Today, the FOMC decided to
Somebody
leave our
is angry.
and to continue to reduce our securities holdings. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. I have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. GDP growth in the fourth quarter of last year came in at 3.2%. For 2023 as a whole, GDP expanded 3.1%, bolstered by strong consumer demand as well as improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have weighed on business fixed investment. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2% this year and 2% over the next 2 years. Participants generally revised up their growth projections since December, reflecting the strength of incoming data, including data from the labor sector. The labor market remains relatively tight, but supply and demand conditions continue to be tight. Over the past 3 months, payroll job gains averaged 265,000 jobs per month. The unemployment rate has edged up but remains low at 3.9%. Strong job creation has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of inflation. Nominal wage growth has been easing and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressure on the median
There's the downward move.
is 4.0%.
First move up, second move down. This could be our second move. Yeah, look at the 15-minute, Josh.
Inflation has eased notably over the past year.
That's just, see? First move up, second move down. Every fucking time.
And other data indicate that total PCE
Every fucking time.
2.5% over the 12 months. And that excluding the volatile food and energy categories, core PCE prices rose 2.5%.
All right.
Longer term
I had to
inflation
freaking ban some of these.
as reflected. in
Wait,
broad
damn
did you delete
scammers.
one of my chats?
No.
Or did I post it in the general chat?
The
Oh, I
posted
posted
in-
in the general. Oh, whoops.
median projection in the S&P for total PCE inflation falls to 2.4% this year, 2.2% next year, and 2% in 2026. The Fed's monetary policy actions are guided by our mandate to
Dude,
promote
look at
maximum
the.
employment.
There's a huge divergence between futures and between SPY.
My colleagues and I are
Do you see this?
imposes significant hardship.
Look at the 1 hour on futures. Look at the 1 hour on SPY. Actually, futures is starting to catch up to SPY. This is starting to look very.
They're strongly
bearish.
committed to inflation.
Yeah, dude, that's what I'm saying. That if that's why for top I wanted to move down first,
for the federal funds rate,
and we did not fucking get it.
and to continue the process of significantly reducing our securities holdings. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are coming into better balance. We believe that our policy rate is likely at its peak for this tightening cycle, and that if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year.
He just said it's gonna be this year.
It is uncertain, however, and we remain highly attentive to.
Gosh.
We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate.
But they're gonna do it longer
We
than
know
one.
that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation, and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity. In considering any
Yada
adjustments
yada yada. We've heard this from
to the funds
before.
rate, the committee will carefully assess incoming
Guys,
data.
you want to tag everyone on what I said in the general?
The
Okay, I'll
committee does
tag
not
everything.
think it's appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably down toward 2%. Of course, we're committed to both sides of our dual mandate, and an unexpected weakening in the labor market could also warrant a policy response. We will continue to make our decisions. In our S&P, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges a scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 4.6% at the end of this year,
What?
3.9% at the end of 2025, and 3.1% at the end of 2026. Still above the median longer-term interest rate. These
What?
projections are not
Market likes that
And
apparently.
here we go.
expected.
Here we go.
As appropriate to foster our maximum employment and price stability.
Oh, dang.
Turning to our balance sheet, our securities holdings have declined by nearly $1.5 trillion since the committee began reducing our portfolio. At this meeting, we
Trillion.
discussed issues related to slowing the pace of decline in our securities holdings. While we did not make any decisions,
Onward.
the general sense of the committee is that it will be appropriate to slow the pace of runoff fairly soon,
What?
consistent with the plans we previously issued. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach that ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitate
I'm out
money
of puts.
holdings consistent with reaching the appropriate level of ample reserve.
We're not going down.
We remain committed to bringing inflation back down to our 2% and to keeping our longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and price stability over the long term. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We
Taking one more scout, boys.
to achieve our maximum employment and price stability.
How's it going, Nicole? Yes, ma'am. How are you doing?
From CNBC, Mr. Chairman. The projections show somewhat higher core inflation. They also show somewhat low. What can we infer from this notion on average? Rates were but inflation is higher and growth is higher. Does it mean more tolerance for higher inflation and less of a willingness to slow the economy to achieve that goal?
Well, it doesn't. No, it doesn't mean that. What it means is that we've seen incoming, as I pointed out in my opening remarks, we did mark up our growth forecast, and so have many other forecasters. So the economy is performing. And the inflation data came
flagging, bro.
Yep.
I think that caused people to write up their inflation.
He just said that inflation is not related to what he's talking about.
I can get back in these 520s at the same
Well, when you
price.
say that you're willing to either maintain the rate for longer, what is the tolerance of the Federal Reserve for inflation coming in above its 2% target?
We're strongly committed to bringing inflation down to 2% over time. That is our goal, and we will achieve that goal. Markets believe we will achieve that goal.
2% in quotations, 3%.
Over time.
All right, long again.
He just said that their numbers are under 3%.
They are.
I'm long. This looks like it wants to flag and go, dude. Oh my god, they're up 20% already. What the fuck?
Told you it's gonna
Premiums today.
It's gonna keep pumping for the rest of the day.
PCE, does that challenge your assumption about when the shift will finally break through to the present set?
So I think
These premiums are insane.
That the market rents, lower market rent increases that we're seeing will show up in measures of housing services inflation over time. There's a little bit of uncertainty about when that will happen, but there's real.
Oh my god, they're up. Oh my god.
Eventually.
I could be
Did it hit 65?
Jesus.
And will you be able to get overall inflation down to target if housing doesn't break through quickly, and does that affect the timing for eventual cuts this year?
We will get aggregate inflation down to 2%.
Print. These are going to absolutely print.
I would assume that what we'll continue to see is we'll see good
40%
price,
already.
new equilibrium where they're going down, perhaps not as quickly as they had been earlier this year, where housing services inflation will come back down as current market rents are suggesting will happen, where non-housing services will move back down. Some combination of those.
Send this motherfucker, dude. Send it. 51%. 60%. Send it. Send this motherfucker. Send this motherfucker, dude. Oh my god. I bought it right before the breakout, bro.
Send it.
Send this
Hey,
motherfucker,
okay.
dude.
Whoa, whoa. Easy, Tigers.
Calm
Calm
down.
down.
Interest rates are well above neutral.
Calm down. I'm live on
All-time highs,
YouTube.
baby.
First cut is highly consequential. Can you reconcile these views for me? If rates are well above neutral, why would the first cut be highly consequential? Is that because you anticipate one cut would be followed by one or two more along the lines of the recalibration you made in 2019, which itself was modeled on the mid-cycle adjustments of 1995?
It's more, I would put it more in the context of what I said in my opening remarks, that the risks are really two-sided here. We're in a situation where, if we ease too much or too soon, we could see inflation come back. We could do unnecessary harm to employment and people's working lives. And so, we do see the risks as two-sided. So it is consequential. We want to be careful. Unfortunately, with the economy growing, with the labor market strong, with inflation coming down, we can approach that question carefully and let the data speak on that. That's really what I was thinking.
And so far this year, you chalk up to one-off calendar adjustment effects following a period of high inflation versus some change in the trend we saw in the second half of last year.
I want to start by saying I always try to be careful about dismissing data that we don't like. So you need
Defending
to
the EMA is still at a bullish trajectory.
I would say the January, which was very high. January
This is
CPI.
big resistance, bro. This is a triple top. It's
It
big
is.
resistance. It's gonna take a second, but I think it's gonna get through.
But nonetheless, we don't want to be completely dismissive. The February number was higher than expectations, but we have it at currently well below 30 basis
Dude,
points.
good shit unloading those puts today,
It's
dude.
not terrible.
This
So
would
it's
have
not
really hurt.
anywhere.
Yeah.
But I take the two of them together, and I think they haven't really changed the overall story, which is that of inflation moving down gradually on a sometimes bumpy road toward 2%.
Come on.
I don't think that's has
Send
changed.
this motherfucker, dude.
I also don't think that those readings added to anyone's confidence that we're moving closer to that point. But we didn't. Last thing I'll say is we didn't excessively celebrate the good inflation readings we got in the last 7 months of last year. We didn't take too much signal
All right,
of that.
I closed all but one. I left a runner, 72%.
There you go.
I'm way too hyped up about it.
Decision. And we're not going to overreact as well to these 2 months of data, nor are we going to ignore them.
There we go.
Boom.
Hi, yes, Chair Powell. I could you speak a little
Beautiful, dude. I left one runner. See how far it wants to go.
enough data?
520?
If it goes to 520, dude, these are gonna go up like 200%. I'm way too emotional about it, dude. I was heavy as fuck again. I went heavy on every single one of those trades today. 4 for 4.
Yeah, so we make
Dude, let's go
decisions.
party, bro. Shit. Nah, I'm kidding. It's a joke.
Future meetings today.
Good.
Those are
We're not even done yet.
of the income
I know.
data view. Also risk. So I really don't have anything for you on any specific meeting looking forward. We'll take things can happen during an intermediate period. We look back, unexpected things. So I wouldn't want to dismiss anything.
Oh,
so,
they're up 98%. Oh my god, dude. 103. I have not seen a trade like this in a while on a 0 to date. Holy fuck.
to mention. We don't see this in the data right now, but if there were a significant weakening in the data, particularly in the labor market, that could also be
120
for us to begin the process of reducing rates. Again, there's nothing in the data pointing at that, but those are the things that we'll be looking at coming meetings, and without trying to refer to any specifically.
Hi, Chris Reaver at Associated Press. Thank you.
There we go. We're going to 520, dude. How far up are you now?
Dude, I'm up. Oh my god. Oh shit, 120.
There you go. Wonderful. That's fantastic.
That's insane, bro.
That is insane, bro.
Oh my god.
In some way that higher rates will be needed in the future. Thank you.
So you're right. They're pretty modest changes, but you're right. There was an uptick.
Oh my god, this is insane.
25 basis
Holy shit.
26. In terms of are rates going to be higher in the longer run, if that's really your question. I don't think we know that. I think it's
did a complete reversal is now bullish.
Control prices era for reasons that are mostly
30-minute firing, 15-minute firing, 5-minute confirming,
demographics and productivity and that sort of thing.
Oh my god. Let's fucking go.
My instinct would be that rates will not go back down to the very low levels that we saw, where all around the world there were long run rates that were at or below zero. In some cases, I don't see rates going back down to that level, but I think there's tremendous uncertainty around that.
Great. And just a quick follow on the projections, you also have 2.6% core inflation for the end of this year. It's already you mentioned it being 2.8 in February. And that doesn't sound like much disinflation at all. So are you still confident? Or the last press conference you sounded pretty optimistic you would get more confidence at the end of this year. Is it right to say that this suggests you're not seeing a lot of disinflation this year compared to what we've seen 2023 and so forth?
I think that higher year-end number reflects the data we've seen so far this year, because you're now in this year. So I think that. Sorry, say your last part of your question again.
Oh no, Powell's retarded.
I think if you look at the SEP, what it says is that it is still likely in most people's view that we will achieve that confidence and that there will be rate cuts. But that's really going to depend on the income data. It is. The other thing is in the second half of the year,
You keep typing in general chat, so trader chat, Austin.
Progress as you move that 12-month window forward. Nonetheless, we're looking for data that confirm the kind of low readings that we had last year, and give us a higher degree of confidence that what we saw was really inflation moving sustainably down to 2%, or 2%.
Gina Smith, the New York Times. Thank you for taking our questions. Per your comment, Anne, that a weakening in the labor market would be a reason to potentially cut rates, or at least a consideration in making a rate cut. Would continued strength in the labor market be a reason to hold off on rate cuts? And just in general, if labor supply continued to rebound in 2024 the way it did in 2023, what would stronger hiring and possibly stronger growth mean for the path forward on policy?
Yeah, so if what we're getting is a lot of supply and a lot of demand, and that supply is actually feeding demand because workers are getting paid and they're spending, and that's, what you would have is potentially kind of what you had last year, which is a bigger economy where inflationary pressures are not increasing. In fact, they were decreasing. So you can have that if you have the continued supply side activity that we had last year with both with supply chains and also with growth on the side of the labor force.
So strong hiring in and of itself would not be a reason to hold off on rate cuts.
No, not all by itself. No, I mean we saw you saw last year very strong hiring and inflation coming down quickly. We now have a better sense that a big part of that was supply side healing, particularly with growth in the labor force. So in and of itself, strong job growth is not a reason, for us to be concerned about inflation.
Hi, Chair Powell, Mueller with Axios. How do you assess the state of financial conditions right now? And in particular, do you view the kind of easing in financial conditions since the fall as consistent and compatible with what you're trying to achieve on the inflation mandate?
So we think there are many different financial conditions indicators. You can kind of, see different answers to that question. But ultimately, we do think that financial conditions are weighing on economic activity, and we think you see that in a great place to see it is in the labor market, where you've seen demand cooling off a little bit from the extremely high levels.
Look at Meta lead the way.
Job openings, quits, surveys, the hiring rate, things like that are really demand. There are also supply side things happening, but I think those are demand side.
Apple calls are in the green right now.
Costco's at our cut spot.
Progress of inflation.
I don't even care about that anymore.
Significant progress.
Yeah, no problem.
What are we down? Oh yeah, that's a cut.
Tesla's going for a breakout right here.
Thank you. Have a good one.
Costco.
Bitcoin's rallying too.
Inflation dynamics now. What we've seen at the beginning of the year, one-off increases that will fade, or is there more of a secular turn with goods prices rising again and service prices staying sticky? And also, housing prices have been sort of the Godot of this cycle, in that you keep expecting them to go down and they don't. How does the committee see this playing out forward since you've raised your inflation forecast?
So I see the committees looking at the 2 months of data and asking the same question you're asking and saying we're just going to have to see what the data show. As I mentioned, you can look at January with a very high reading, and I think many people did see the possibility of seasonal adjustment problems there. But again, you got to be careful about dismissing the parts of the data that get flex. So, then February wasn't as high, but it was higher. So the question is, what are we going to see? We tend to see a little bit stronger. This is in the data. A little bit stronger inflation in the first half of the year, a little bit less strong later in the year. We're going to let the data show. I don't think we really know whether this is a bump on the road or something more. We'll have to find out. In the meantime, the economy is strong, the labor market is strong, inflation has come way down, and that gives us the ability to approach this question carefully and feel more confident that inflation is moving down sustainably at 2% when we take that
Monster day, boys.
Yeah, it's going.
Continually moving down. Numbers we've gotten for inflation data dented that confidence at all?
It certainly hasn't improved our confidence. It hasn't raised any of its confidence. But I would say that the story is really, and that is of inflation coming down.
You could go all the way to 523 here.
Hey,
Dude,
my gold
Josh,
is
remember those
finally
pivot
making
points
me
I was
money.
looking at? Let's take a look at them again.
I think you go to 520 potentially, all the way to 523.
521.04 is that pivot point. That's what I went over last night. We held, dude, Josh, look how we held this pivot point. That 515.43.
Yeah.
That's what I was watching all. That's why I took those calls and I was just watching all day. If we broke that, I was like, fuck it, we'll cut them and reset. Dude, this is. I hope this. If this just keeps green candling, I can get 200 something %. If it stays chopping.
Mara is up another $1.
Raise rates again.
Tesla is rallying.
I like the Tesla rally.
Roku is rallying. Apple is rallying. Alibaba is rallying. Everything is rallying.
Independent body and standing Congress has oversight over that. Received a letter from Senators Elizabeth Warren and Sheldon Whitehouse.
Oh shit!
That,
okay. I am making the money.
Potential that it may remain too high for too long has halted advances in deploying renewable energy technology and delayed significant climate and economic benefits from these projects. So it has higher interest rates caused them.
Oh man.
First of all, I respect. We in our system of government, it is Congress that has oversight responsibility.
Setting to cut it, break even on these.
Tremendous amount of importance.
Not gonna lose money on a runner.
Always treat them with great respect.
Not gonna lose money.
Those are, our mandate. Our mandate is for maximum employment and price stability, and the other things that we do.
We'll do what we tell you.
That's what we're trying to accomplish. We're trying to do that in a way that sustains the strong growth we're seeing, the strong labor market we're seeing, but allows us to make further progress with inflation. That's how we can best serve the public and leave the other issues, and in many cases are incredible.
My runner will not go red on me. Gotta stop. I'm actually setting a stop loss.
There's another letter from 2 dozen lawmakers saying that the higher rates are squeezing the working people. How do these letters affect what you guys are doing policy-wise?
We receive these letters with respect, and we write careful responses and address concerns. We listen, again, because we're talking to the people who in our system of government have oversight over our activity. So but at the end of the day, we take that on board, but we have to make our judgments and we have to stick to our knitting, which is maximum employment, price stability, supervise and regulate banks, work on the payment system, the things that we do.
Claire Jones, Financial Times. Thanks a lot for the opportunity to ask a question. As chair of the FOMC, would you want to see unanimity on the committee or something close to it, meaning no more than one dissent before you begin cooking it? Thank you.
We're a very consensus-oriented organization, and we do try to achieve consensus. And ideally, people do dissent. It's something that happens. Life goes on, and it's not a problem. We've always had dissent, so you respect thoughtful dissents very much. Like you may not agree with some arguments, but you really want to understand them. So you may read a book that takes a position that you have long opposed, just to understand that book. So I treat dissents with real respect as well.
Well, fucking red, seasoned, well-rounded guy Jerome Powell is on this.
Can you hear me?
Yes.
Okay, great. Obviously, inflation is some ways away from
target. Unemployment, though, if you look at the projection for the full year, 4.0%. In February, we were already at 3.9%, so quite close to the median projection. Are you concerned at all that, notwithstanding the very strong jobs growth, that in fact there may be some cracks appearing in the employment market? You talked about a significant deterioration in the labor market being a condition for easing rates. What would constitute that in your books? Thank you.
So we, of course, monitor one of our two goal variables. We all monitor the labor market very, very carefully, and I don't see those cracks today. And we follow all the possible stories that are out there about there being cracks. But the overall picture really is strong labor market. The extreme imbalances that we saw in the early parts of the pandemic recovery have mostly been resolved. You're seeing high job growth. You're seeing big increases in supply. You're seeing strong wage growth, but wage growth is gradually moderating down to more sustainable levels. In many, many respects, the things are returning more to their state in 2019, which we can think of as normal for this purpose. That's job openings, quits, and surveys of workers and businesses are always interesting on this. How easy is it to find a job? How easy it is to find a worker? Those surveys have both come down. So the labor market's in good shape. You do see things like the low hiring rates, and people have made the argument that if layoffs were to increase, that would mean that there would be fairly quick increases in unemployment. So that's something we're watching, but we're not seeing it. Of course, initial claims are very, very low. If anything, have tracked down a little bit. So watching it carefully, don't see it. And when I say something, I use the term unexpected weakening of the labor market. So, we do expect the unemployment rate to, the forecast is that it would move up, I think, closer to what we see as the longer run sustainable level. That's just people's forecasts, individual forecasts. But we're talking about something that's unexpected. That's where I'll leave it though.
Steve Matthews with Bloomberg. You mentioned at the beginning of the press conference that the committee thought it might be appropriate to slow the pace of asset runoff fairly soon. I'm wondering, when you say fairly soon, does that mean that the committee would meet about this again in May and a decision could be reached that soon? And I was wondering if you could also just describe the scope of what the committee is discussing here. You're at $95 billion of caps right now. Would that be cut about in half or something in that nature? Thank you.
So that is what we're discussing essentially is and we're not discussing many other balance sheet issues. We will discuss those in due course, but what we're really looking at is slowing the pace of runoff. There isn't much runoff among MBS right now, but there is in treasuries, and we're talking about going to a lower pace. I don't want to give you a specific number because we haven't made
running off these treasuries, motherfucker.
Decision, but that's the idea, and that's what we're looking at. And in terms of the timing, I said fairly soon. I wouldn't want to try to be more specific than that, but you get the idea. The idea is, and this is in our longer run plans, that we may actually be able to get to a lower level because we would avoid the kind of frictions that can happen. Liquidity is not evenly distributed in the system, and there can be times when, in the aggregate, reserves are ample or even abundant, but not in every part. And those parts where they're not ample, there can be stress, and that can cause you to prematurely stop the process to avoid the stress, and then it would be very hard to restart, we think. So if something like that happened in 19, perhaps.
He's saying those middle class white people have all the money.
We're looking at what would be a good time and what would be a good structure, and fairly soon is words that we use to mean fairly soon.
And will there be a discussion about returning to an all treasuries balance sheet at some point?
What?
So that our longer run
what the fuck
is to return to a balance sheet that is mostly treasuries. I do expect that once we're through this, we'll come back to the other issues about the composition and the maturity and revisit those issues. But it's not urgent right now. We want to get this this decision made first,
What a
and then we
retarded
can,
question.
when the time is right, come back to the other issues.
Hi, Victoria Guido with Politico. Also on the balance sheet, can you talk a little bit about how the outlook for the banking sector might impact your balance sheet plans? Do you worry that as deposits start to shrink that we could see more turbulence?
We'll be watching carefully, but one of the reasons we're slowing down, we will soon enough, fairly soon, I should say, slow down, is that we want to avoid any kind of turbulence. I wasn't thinking particularly about banking sector turbulence, but we had some indicators the last time. This is our second time in doing this, and I think we're going to be paying a lot of attention to the things that started to happen and that foreshadowed what eventually happened at the end of that tightening cycle, where we wound up in a short reserve situation. We don't want to do that again. And I think now we have a better sense of what are the indicators. It wasn't so much in the banking system as it was around, for example, where federal funds is trading relative to the administered rates, and where
oh my god, it's pumping again.
We will always be watching the banking system for similar signs.
Well, is it also because you're not sure?
That was
exactly
another great call entry there, dude.
Repo facility, drops near at zero.
Well, I think we broadly think that once the overnight repo stabilizes either at zero or close to zero, that as the balance sheet shrinks, we should expect that reserves will decline pretty close to dollar for dollar with that.
Hi, Chair Powell, Jean Young with Japanese. I wanted to ask also about the balance sheet. You said that starting the taper sooner could get you to a smaller balance sheet size. Does that mean you don't have to make a decision on when to end QT at this point? And will you be setting up the process for deciding that sooner, or will you wait until we're close to it?
So it's sort of ironic that by going slower you can get farther, but that's the idea. The idea is that with a smoother transition, you'll run much less risk of kind of liquidity problems, which can grow into shocks and which can cause you to stop the process prematurely. So that's where, in terms of how it ends, we're going to be monitoring carefully money market conditions and asking ourselves what they're telling us